This will be a primer on the macro market conditions prior to our panel, and then we'll have a discussion with our illustrious panel to, we'll answer some questions, have some Q&A, and elaborate on this discussion. So I wanted to start with this quote that I heard last week from a mentor in the CDL room, where we're discussing current market conditions and whether or not it's worth raising in the current environment with valuations being compressed. And this mentor just said, ventures don't die from dilution, and they die from a lack of funding. So something to consider as we look to proceed through the presentation. All right, so our agenda here, we're going to take a look at venture valuations in 2021, where, post-COVID or immediately post-COVID, we saw record-breaking funding, we saw interest rates being kept low, and then what that led to in 2022 and then today, as we're now seeing the correction of these conditions. So 2021, we'll start here. So in 2021, what we saw was record-breaking levels of investment. So this data on the right is from the Canadian Venture Capital Association. In Saskatchewan in particular, we saw over 1,200% increase in the amount of dollars invested. In Alberta, we saw a 64% increase in deal count, as well as the most IPOs on record in Canada at 8 IPOs with a total value of $2.9 billion. And so this exuberant market actually led to new entrants entering the venture capital market. So on the right here, you'll see Targa Global, which is historically a private equity firm, and because they were so impressed by the returns in the venture space, they actually decided that they were going to become venture capitalists. And what happened here was that they were doing very little diligence and writing very large checks, which meant that a lot of VC firms or traditional VC firms had to scramble to keep up with the pace of deal making. So it forced people to do less diligence and write larger checks than we normally would. So why did this all happen? Well, it's the interest rate policy and accommodative monetary policy in response to COVID-19. So interest rates were lowered to 0.25% in the wake of COVID because the central banks wanted to stimulate economic activity. And what that did was it led to asset price inflation. So when money is cheap, the cost of debt is cheap, people borrow, and that money finds its way into all sorts of assets. It found its way into crypto, the public markets, and largely into startups. So this data on the right here is from Bloomberg, and what they did was break down what happened during COVID into 4 separate acts. So in March of 2020, many ventures or many companies, publicly traded companies, you'll see on the right side there, they suffered significant losses even from February. So in 1 month, some companies lost over 50% of their value overnight, essentially. But in response to that, and in response to accommodative monetary policy, a year later, those same companies were up, some of those companies anyway, were up over 50%. And so, that's a result of more money in the system and cheaper debt, which caused, again, as we mentioned, this asset price inflation. So that brings us to 2022, where efforts were made to contain that and try and get it back to where historical norms were. And that's led to a downturn in assets across the board. So again, going back to the Canadian Venture Capital Association, it was the lowest year on record for VC exits with a 92% decline in exit value, and going from a record number of IPOs to no IPOs. So some insights on the right here, we have sort of a summary from an experienced VC, hearkening for, he's asking for a return to the disciplined deployment of capital. No more racing after the hottest deal, no more, limited diligence when writing checks, going back to the way things were prior to these market conditions. And, we're seeing now more bridge rounds as well to support portfolio companies, meaning that even if a company has materially advanced their milestones, the valuations don't necessarily increase because of what's happening in the broader market. Also, we're seeing more advice now to raise anywhere from 18 to 24 months runway to deal with these uncertain conditions, where historically that might have been somewhere between, let's say, 12 and 18 months. So where are we today? So overall, the price of money is now 18 times more expensive than it was before, and that's just based on interest rates. So when the cost of debt goes up and the cost of borrowing goes up, valuations on all these assets. Now all that money is trickling out of them. It's more of a gush than a trickle, as we're seeing. And valuations downstream are off by anywhere from 30 to 50%, so late stage venture in particular. But from our discussions, as you see, we have relationships with a number of VC firms, and we're starting to see these trends moving upstream as well, because ultimately we have to look at what our exit is when we're making investments. So if it's off by 50% downstream, that'll have to trickle up, and we are seeing that in our discussions with VC firms out of Vancouver and Toronto. These headlines are just from this month alone. So you can see Canadian venture capital investment down 82% in Q1 from the year before. And Tiger is not doing so hot. So their lack of diligence, fast checks, that doesn't work. When market conditions return to normal, it just doesn't make sense to operate that way. Here are some case studies from a number of different companies. Interestingly, the only one that really benefits out of this list from COVID lockdown policy is really Tonal, and that's a home gym company. But you're seeing even Wealthsimple, Klarna, which is another fintech company, down significantly. And Paul Parisi, who is the head of Silicon Valley Bank, was noting this exuberance in this article when he said, Series A historically has been around $16 million. He was seeing Series A rounds up to $50 million not being uncommon during the run-up in the pandemic. So now what we're seeing is a regression to the mean, and we're seeing a return to normal market conditions, which has been quite uncomfortable for a number of ventures that raised during that height of exuberance. So 4 considerations for this year. The good news is you're in the right place. We have a great ecosystem here, and you're going to hear from a number of our panelists that represent some of these organizations. It's important to think about your existing investors as well, because they will often be your best source of capital when you're leading your next round or looking for a lead for your next round. You should also consider raising more rather than less, because the future is still very uncertain. So even though that may mean more dilution up front, still worth considering, because market conditions are not stable even as of now. And we're seeing that in the continued rise in interest rates. And also, it's important to control what you can. Try and hit your milestones, do everything that you can to make your venture successful, but also understand that even you being successful may not increase the value of your venture, because macro conditions are changing so rapidly and so aggressively that you may have to consider raising a bridge round or a flat round, even though you've done everything right. And so with that, I'll leave you with circling back here to what the current market conditions are indicating.
Hi, everyone. Thanks so much for having me here today. I appreciate the opportunity. My quick spiel is I'm an investment associate with Yaletown Partners. We co-manage the Accelerate Fund alongside a group from Calgary called the A100. If you know them, they're a nonprofit here. We're on the 3rd iteration of our Accelerate Fund series. This fund is $23 million. We look for pre-seed and seed stage companies that are exclusively based in Alberta. So part of our criteria is that you have 50% or more of your full-time employees based in Alberta at time of investment. We look for B2B tech plays, typically on the SaaS model, but we've gone and expanded throughout lots of different industries. So we've got some life sciences, we've got fintechs and the rest. Our typical check is about $250,000. And what is unique about Accelerate Fund is that we are an angel matching fund. So any dollar that we put into an investment needs to be matched 1-to-1 by angels or private investors in your round. It's a way for us to stimulate private investments into Alberta-based businesses. They can be from anywhere in the world. And we do reserve capital for some follow-on as well. So that's really for us, it's a way for us to ensure that we are getting you ready and prepared for your Series A, those growth stage rounds of funding as well. So I'll leave it there. I'm sure there's lots more questions though.
How much money have you deployed so far within the fund?
We're on year 3 of our fund so far, and we've deployed we have 6 companies left, so it's about 40% of our 55% of our investable capital so far. We're about halfway through the investment pacing, but a year left in our investment capital. So we still have another 6 companies to do here in the last year of our investment. So I wish I knew the math on that last one, but it'll iterate, right? Because we can do 250, or it can go up or down from there depending on the investment in front of us.
Excellent.
Perfect.
Thank you. Meg.
Okay.
Yasmine, have a seat.
Oh, up here.
Hi, thanks for having me. I'm Meg Bregazzi. I'm the founding partner for Adara Venture Capital. We're angel investors, much smaller. We started in January 2022, so we're about a year and a half into it. We focus on life science companies in Western Canada. It's me and 5 friends, so the 6 women, and we're looking to support innovation and support companies that we think can make a difference in the life science space. We're closing our 8th company investment this month, and so that'll be about $700,000 to date in the year and a half, and mostly in Alberta, but we have 2 in BC that we've closed. And you mentioned what sort of companies do we look for, and first we look for technology that's meaningful to us, that we think can make a difference and that we feel good about investing in. And then we look to the team and see, do we like the team? Like, do we believe in this team? Do we believe they can make a go of it? But also we're investing with them, we're partners with them. Do we want to be in business with them, and vice versa? Do they want to be in business with us? Do they want us on the table? So far we've been very happy with our investments, and we plan to continue. And thank you very much for having me, and I'm looking forward to hearing the questions and the other panelists.
Just a quick question. Do you have any sense of how much capital you want to deploy, or is it just, as we keep seeing interesting things, we're going to keep going?
Yeah, we hope to keep going. We haven't really said. It's 6 women. We've had lots of interest to join us, so we may expand it, and it's all in progress.
Excellent. Wonderful. Thank you. This is Adrian from Startup TNT.
Yeah, hi. Adrian, Startup TNT. I see some familiar faces in the crowd. Thanks for having us here. So Startup TNT, if you don't know us, we were started in Edmonton in 2019 as a happy hour among angel investors and startup founders to try and sort of stimulate their economy. The investors who were going to this happy hour on a regular basis decided to throw an investment summit, which was a kind of a pitch opportunity, not a competition. And from that, I think of that first one, 3 or 4 companies got investment, and then when they expanded to Calgary during the pandemic, and now we're in Saskatchewan and Winnipeg. So we've now done 22 investment summits in those 3 years, since February 2020 to now. We've done 22. We're in the middle of doing 4 more right now. And we've deployed $10.3 million into 73 startups across the prairies. We are in Alberta specifically, so we have about 50 of those companies are in Alberta. We started here. And in Calgary, we have 25 investments in Calgary, and we deployed $4.2 million in Calgary. Proud to say 40% of that is into female-founded companies, and 33% of it or so is into BIPOC-founded companies.
Excellent. That's great. And so average check size is?
Well, if you do the math on that, so we've done a little follow-on now, because now we're 3 years in, so about 600,000 of that is follow-on. But our average initial check size is about $120,000.
Excellent. Wonderful.
But our average winners generally are getting $200,000+.
Yeah. That's great, and growing really fast. Congratulations.
Thanks.
Yeah. Excellent. And last and certainly not least is Luke Shen.
Thanks, Pete. My name is Luke Sheen. I'm the founding executive director of Halo Health. We are a physician-exclusive pan-Canadian angel investment group. So we got about 390 physician investors across Canada, representing 40 different subspecialty in medicine. What do we look for? Well, we go in usually first check pre-seed seed. Average check size, I would say $150K per startup. We have done up to $350K USD and have done up to Series A, but we're looking for pre-seed seed for first-time meetings. We look for startups that are directly clinically correlated, and how we define that is, does the startup need the physician, and does the physician need the startup's product? That's kind of our first litmus test. And then we also have our expertise and shared intelligence for doing our due diligence, but if you meet those criteria, we'd love to chat. We don't discriminate within any healthcare verticals. We've done 42 investments in 3 years with 4 exits, 2 IPO, 2 acquisition, and they range all the way from digital health to pharma, device. We even just did a healthcare fintech play. So happy to be in Alberta. We're officially set up now in Platform Calgary. We have actually, I want to give recognition to our full-time staff, Dr. Connor Anderson, who's with us, who's going to be friendly to all of you. So we're very glad to be in Alberta, and so far we've executed 5 investments in this lovely province and hope to partake more in this ecosystem. So thanks for having me.
Excellent. So before we get into questions, just for the benefit of the panel, I think for everyone here, like, can you just raise your hand if you've raised capital so far? Okay, excellent. So 4 or 5 different groups, great. How about folks that are thinking, whether it's the people who've raised capital before or not, folks that are planning to raise this year? Excellent. And folks that are thinking, like, probably not this year, but following year, or is there any folks in the room that have been in that category? Okay, excellent. So kind of a mix of folks here. Okay, great. So why don't we start? We'll kind of pass the mic down, so the people at the ends have the hardest time because people get to say things first. But Luke, why don't we start with you, and we'll go this way. Like, what's your view of the macro? Like, you heard a little bit about what we think we're seeing from the data, what's being communicated. What do you think? What do you see? You have operations in Toronto, so you have a lot of docks in Toronto. So are you seeing any trends in the early stage market in Toronto that perhaps we haven't seen here yet?
Yeah, so I'll draw evidence from what I know. And, I was just out back in Toronto for Bloomberg Healthcare VC conferences. And yes, it's very true that a lot of startups in the last 2 years got a lot of funding, made the valuation really inflated, and then went IPO early. I mean, these days, to be candid, really easy to list on TSX. And, a lot of them small cap, they went public, but look at their share price now, like down 50, 80, 90%. So, for our space in the earlier investment space, I think it's about 2 to 3 year delay to what the capital markets is showing. What I did see from the conferences and investors and other startup companies and portfolios they hold is that the capital markets in bio-specific life science sector is pretty much hit the floor, which means that, a lot of people think it'll bounce back. There's some indication of that, not quite yet. I think we still got to wait a couple quarters to see, but, what that means is that we're discounting 3 years. So then the valuation for startups are coming down, but capital markets is going back up, which means that I think, startups right now is a time to be very careful about the valuation, and that got caught up into the mistakes that were made 2 to 3 years ago. So is there a singular trend specific in life sciences and medical device and what we invest in? But I would say right now is all-time low, but I think there could be a bounce back soon. But startups need to be very careful about their valuation right now in order to raise properly.
Adrian, what are you seeing across the prairies? You guys are across Alberta, Saskatchewan, Manitoba. Are you seeing any trends across the prairies and more locally that we should be aware of?
It's, I guess, less more anecdotal, more observational, less evidence or data because I haven't looked at it specifically. But what I feel is that certainly in Alberta, with the oil price recovering the way it has since pre-pandemic or the early pandemic, I think we are seeing more capital available. But of course, and then I would definitely say though that we went through a period in 2001 of massive, so Amit's presentation there, big investments, people deployed a lot of money, and then I think people sort of stepped back and said, well, maybe we've deployed too much, and 2022 was a bit of a they were checking in, and maybe valuations are too high. There was a bit of a shock, a bit of a rebound effect there. So I think that it's a mix, and it's certainly related to the markets. When the markets are down, people are less interested in investing in startups because it's higher risk, and they're trying to recover from their conditions. As the markets recover, we definitely see more people interested. But I think there's a huge appetite in the prairies and certainly in Alberta to diversify the economy. So there's a massive appetite to fund companies that are not working just in energy, that are working in healthcare, that are working in life sciences, not just healthcare, but life sciences and in all kinds of other tech. We have aerospace tech. We have a number of other companies doing things, and there's a huge appetite for that. So I do think that there's investor interest, and there's certainly political interest and political momentum to have that done. And I think we're at the nice moment for angel investing in Alberta companies. But I think I'll pass the mic at this point. Thanks.
Could I ask one question before you pass the mic? So
Sure.
You're in an interesting place where you guys are trying to catalyze, much like other folks, angel investors. Meg, you've got a group of 7 that you've brought together. How are you finding that recruitment? Or is it the same investors, or are you feeling like there's more people coming to the sector? Because that's really a big part of what you guys are doing. Like, do you feel like that's there's still more people coming in all the time looking to learn about investing and looking to be in the space?
So there's a mix, right? So actually we have a lot of angels that got very into the space, and now they've actually deployed quite a lot of capital, and they're looking at their asset blend and saying, well, maybe I need some exits before I continue to put more money in here. So they're looking for exits, and certainly, I mean, we know that 2020, 2021, there was a lot of startup investment. So I think people are waiting for those companies. It's going to be 3-4 more years to see some exits before they redeploy a lot of that capital. At the same time, with all of the positive things that are happening from the government, from the funding that's going to startups, I think people who've never invested in this asset class are starting to learn about the asset class. There's lots of angel investment courses out there. There's lots, like I see, we're partnering with lots of organizations to help train more angels and to bring more people into this asset class, to get comfortable with the risk profile, understand how to do due diligence on these companies. So we are continuously recruiting new investors, and I think that that's something we've done really well at TNT, and we hope to continue. And I hope to improve as we continue to bring more investors into the space and investing in this asset class.
Excellent. And Meg, as an angel investor, as a person who's brought some people together to invest, how does that resonate with you? Do you feel like you're in the phase of like, we're going to pause for a bit, we've deployed a lot of capital, or do you feel like you're in the phase of, no, we're in good shape, we're going to keep going for a while here?
I think that we see a lot of opportunity right now with the deal structure, the terms. There's a lot of bridge rounds where we've seen a few deals where we agree to it, and then suddenly the term, we're not leading it, so we're not negotiating, and the terms are getting better. So we're benefiting from that. So we're seeing the pressure on the companies, absolutely. But I think for me and for my group, it's opportunity to invest, and we're excited about the potential and all the companies out there, and great innovation, great founders.
So just to be clear, you're saying what you're seeing is you're looking at a company, it looks interesting, and then what you're seeing is the deal terms improving because the company's being pressured by a lead investor to either reduce the cap or add terms that would be more favorable to the investor?
Yeah, the discount, the cap.
Yeah. And did you see that 2 years ago or a year ago?
No. It's a more recent phenomenon.
It's more recent. Okay.
Yeah.
Excellent. Yasmine, what about you? A little bit different place. You have a more formal fund, but also more of an earlier sort of pre-seed seed type of fund. How has that how's that been reflected within the organization? So quick, tied to Yaletown, which is a big organization, obviously with the Accelerate Fund, which has a slightly different mandate. How has the last couple of years played out for you guys, and what are you seeing now versus perhaps what you saw in 21, 22?
Yeah, it's definitely been quite the difference atmosphere from 2021 into now this year, coming with the markets and just some kind of craziness all over. But so for Yaletown's, for background for the group here, Yaletown Partners is a VC investment firm based in Vancouver. Our main fund is the Innovation Growth Fund too, that invests in Series A growth style investments and beyond. So very high stage kinds of growth and growth companies, and we invest a little bit early on. So we were kind of like a farm team, if you will, for that larger fund and their investment thesis. So it's nice as a Accelerate fund, we benefit from the evidence that we're seeing at the Series A stage with Yaletown's Innovation Growth Fund. So over the past 2 years, we have very dramatically seen the decrease in either of its valuations or term sheets really changing on these founders, time to raise. There's a lot of different elements that are changing already at the Series A function that we know will trickle down, as Amit had said, into the pre-seed and seed stage funding landscape as well. And I'll just interject here myself to say, in Alberta specifically as well, we only look at Alberta-based businesses, it could be hard to get outside of our own tents, our own bubbles here. There's a lot of media, there's a lot of attention on Alberta, as you mentioned, diversifying our economy. So we're seeing a lot of optimism, which is fantastic. We want to see that, but there's also a lot of no worries. Seed stage investments, you guys are fine. Don't worry about your valuations. Don't worry about where the markets are headed. You're immune. And unfortunately, I don't think that's going to be the case for much longer. We will see some depression coming along, and we're already seeing it at our own fund at the Series A level, and it's coming down to our stage. So we, as an institutional investor, have to be very mindful of all stages of your growth and of your fundraising landscape so that we can ensure that you have proper success along the routes, and we're also making an investment that will return money to our investors at the end of the day.
Excellent. So I'll just leave you with the mic for a sec. So as someone who's been on both sides of investment as a founder and someone who's raised capital myself, there's always this balance between, do I want to take the dilution now? Can I make more progress and get a milestone and then raise? What, from a fund perspective, what are you advising your portfolio companies and perhaps even not, maybe just Yaletown too, like, because I think there's lessons we can learn at an angel level if we believe the market could be changing. Like, is the advice take more money now, not less? Because there's different phases. Like in 2021, markets are getting hot, like capital's available. You could take a small raise and get 1 or 2 milestones out of the way and then raise at a much higher valuation. What guidance are you giving your portfolio companies right now? Because I think there's really important lessons that we might be able to take away from that.
Yeah. And I'll start with what the advice may have actually been in 2021 with the height of some of these capital markets, tailing upwards. The thought was, for dilution's sake and for other reasons as well, if you couldn't raise as much capital today, it's fine. Raise a smaller round now because capital is available, capital is cheap. You can raise again in 6 to 9 months. And we saw that with our own portfolio. We had a few companies that were able to raise within the span of 4 months, radically increased their valuation over time. They got a ton of money and capital under their belts. Now they're feeling the decline of that, and we can talk about that later on. But, that was the sentiment back then, that you could go ahead and raise over and over again, and there was no issue about it. You could kind of control your dilution, but, end of the day, realistically, not really. But, the capital was there and available, almost like free money, if you will, right, and short-term due diligence and all this. Now the advice has shifted, and thankfully, Yaletown Partners Accelerate Fund has never had that mentality from 2021 that Tiger Global had. So we've always been very disciplined and diligent on how we do deals. But the advice today is, yes, raise more if it's possible for you and your company at this time. As Amit said, 18 to 24 months, that is baseline. That's going to be table stakes to ensure that kind of runway for your company's longevity. People don't want to see you going back out to market in a shorter time frame than that, because there's a lot of risk involved, right? How are you going to ensure that the right partners are coming to the table? Do you get desperate when it's that 12-month mark and all of a sudden you're running out of some capital and you need to just bring investors to the table that might not be a right fit for you? So we are saying raise not as much as you can, but raise with a number that makes sense for your runway, with your growth projections, and that will help set you up for that next amount. And just a bit on bridge rounds as well. Lots of bridge rounds are coming up lately, as you mentioned. It's a great way to cap over if you're not quite at the milestones for your Series A. But take that with a grain of salt of understanding dilution will be a part of that. You might not raise as much as you wanted to. How long will it take you now to do a bridge? And how long will it take you to do a Series A? So yes, our advice is a little bit shifted, but it's still there. Raise what you need, be realistic, watch your dilution overall, and get the right partners and capital under the table.
Excellent. I want to move into sort of structuring and more of a valuation discussion. Sorry, do you have anything you want to add to that, Meg? But I want to pause there and just see if is there any questions from the audience in terms of market conditions and this discussion so far?
It's kind of like Peter. I mean, I've been on both sides of the table. So we raised money at a digital health company in 2021. Great market, great time. We didn't know it was going to be the best time in the last 3 years, but it was incredible time to raise. So when you say like favorable for us, that I think what you mean is I'm not giving up more than 20-25% of my company. That's sort of the conventional wisdom, right? That in each round, a real round, you don't want to give up more than 20-25% of your company. Bridge rounds, I think it's different. I don't know what the rule of thumb there is, but I think that's what you're saying. So, but backing up, like what founders I think really need to do when they're valuing their company right now is be realistic and actually have a true understanding of what the market is doing. So we were fortunate enough to have Charles Plant present to us the other day, and he gave some statistics. And so I always hear at CGT, we hear companies complain that in Canada our valuations are so low, U.S. valuations are so high. And he actually said, don't know if it was just last year or it was accumulated over a number of years, he said the median valuation for startup in the U.S. that did a pre-seed round was only $4.8 million US. Now, if I talk to many of the startups I talk to, they would tell me it's 10, 15, $20 million. So the statistics are actually 4.8. So I guess one caution would be understand the realities, don't buy into hype of what you read in the big press. Like do have some realistic expectations of your company. The other thing he said is that those pre-seed valuations were our companies that had a median revenue of $250,000 a year. Most pre-seed rounds we see, half of the ones we've invested in are pre-revenue. 51% of our investments are pre-revenue. So we're actually giving pretty good valuations considering those two factors. So I think that would be one thing is don't fight your investors. Like don't like have an open mind, be realistic, like accept that maybe there's other information out there and take some feedback on valuations. Like don't take it personally, but also I do think that not giving up more than 25% in a round is probably a good thing to think about. So look at your capital needs, figure out how much you can do in 18 to 24 months, and figure out, like, is that a realistic valuation for my company, or do I need to bootstrap this or really pull up my socks for longer before I do that raise? And that would be a big question or a thing to think about.
Well said, Adrian. Yeah. Let's take a step back. So if we look at inflation, depression, we go through ebbs and flows. If you look at startups, some of the greatest, most successful startups tend to be born out of the most harsh environments. So I would say this, you need to survive in order to realize your vision. And sometimes that could look different, but the world is ever changing. So strategy-wise, I would think of it this way. Yes, you might be giving away more of your equity because the valuations are lower. So then think of these investors as someone who would be as close to your co-founder as you can find, someone who will actually move the needle. And it's okay, like other panelists said, that you might have to raise more frequently. So then set realistic milestones that will achieve and is achievable by the people you select. And we may be partial. For example, we invested in a women's health company, 10 OB-GYNs invested. And we got very good terms. Why? Because these folks will pick up the call for you to give you unprecedented medical advisory. They will help run clinical trials. They will invite you to their clinics. So what I'm trying to get at is get smart investors who are aligned with your vision. And you may have to give a piece more, but you have to survive. And then likewise, set micro goals and milestones that are very effective so that you can raise further and you can raise quicker in smaller rounds or subsequent rounds so that you can avoid down rounds. That's really the kiss of death, right? Nobody wants that, and a lot of startups are going through that. And then as you get through to a bigger round, you need money. And those investors don't have to be the smart investors or the needle-moving investors that you had before, because it could be institutional downstream, right? So for now, I would just critically assess where does your venture need to go in order to raise more? What are the milestones that will move the needle to actually create value? That's why they're called ventures, right? Real value. And then be very discernible with investors who are there to add other tangible value besides just their capital. And that's kind of what we've been iterating for our investment companies. And to be frank, the startups that we really love, they come to us for that reason, because they made this realization on their own, which we also love. Much more to say, but I'll yield my time.
Maybe I think there's a few pieces there so I'm going to play devil's advocate. I'm going to take the founder side. Luke, you haven't really answered my question. How do I decide on my valuation? Like what's an acceptable argument? Like what am I going to come in and say? Like I could say, well, I don't want to take the dilution, which by the way is a bad answer, right? Like that's the wrong answer. But if I said, like, what am I bringing to you to say, Luke, this is what I think my valuation and is why, and how do I defend that? And maybe we just go down the row here. I'd love to hear everyone's feedback.
How about this? I'll go last this time around.
Okay. Yeah.
And
Pass.
then we can start all the way.
That was quick. Wowza. Okay. Good. I already love the crowd here. Yeah. Okay. I'll give you a bit of a math answer. I feel like a lot of people in this room, and hopefully are like-minded like myself, we like formulas around here. I don't know if there's scientists in here. You want to be a little bit formulaic about it. So I'll give you a very rudimentary example if I can. How we start to look at valuations at the early stages. So a way to put the number to your company when numbers shouldn't exist. It's all a lot of arts. There's not a lot of science behind how we value companies, although there is. I'm going to contradict myself in a second here.
Just in pre-revenue companies, I think there are some metrics for revenue-based companies, especially if they're SaaS. But if we're talking like pre-revenue type businesses,
And
I think is where you're going with that,
yes,
right?
thank you. Pre-revenue, but also I would say if you're a SaaS business, 1 million in annual recurring revenue. I've done some of the model work on that. The model breaks when I try to put a multiple on something of that sort or, low revenue. So very early stage we're talking here. What we're looking at is what will the future look like? We're trying to predict that as much as possible and as close as possible. So when you think about your seed raise at the moment and how much you need to raise right now, let's look at the forecast, which is going to be murky, we understand, but let's look at a conservative forecast for what you might like to raise at your Series A. And at that time, what will you be at in revenues? And of course, if you aren't a company that maybe you're in life sciences that won't get to revenues, your value is determined differently, we can talk about that, but let's just keep it simple for a SaaS-based business. At that time, let's say your revenue is going to be $2 million in annual recurring revenue, and by then you think that's the metric you need, plus some others to get your Series A. Okay, from there, we're going to see what kind of multiples could be attached to that revenue and at that Series A level. Currently, SaaS Capital, it's a great free resource online. Go to SaaS Capital. They have an index on their website where they aggregate all of the public valuations for SaaS-based businesses, and they give you a multiple every year, every month's end. April 30th of this year, they went down to 6.5 times revenues. That's annual recurring revenues. So that's already a steep decline from the 14 times it was in 2021. So if we're thinking conservatively, we can maybe award you a 6-time multiple at that Series A level. So that's on your 2 million ARR. We're now at 12 million pre-money valuation for that round. As a venture institution, we are looking to double, if not triple, our upside between rounds. So at the least, we're hoping that you're going to double that. So we'll take we'll divide that by 2. Today, your post money is looking like 6 million at this moment, right? And that's based on a little bit of math, a little bit of fiction, a little bit of arts to get it all there. But it gives you a sense of how we're thinking about the future and how we're pulling that back. Because it really matters for us to look at public markets. That's how we're putting a valuation today and how you'll be valued tomorrow, so that we're not overextending yourself and you don't have to grow into a very high, crazy valuation. We've seen companies be hurt by that, taking a valuation that is double, triple what they should be today. How do they grow into that, quadrupling it by the next time that they want to raise? It's almost impossible, and you'll feel the hurt end of it on the backside. So hopefully that answers the question with a little bit of a formula, but it's a nice way that I like to think about realistically what companies can be attracting in terms of value, and then you add that with the ownership percentage, what you'd like to actually give away from your company's standpoint today.
If I could maybe guide the rest, so maybe Meg, to a question for you. So that's more of a formulaic answer as it relates to, say, SaaS companies, right? As an angel investor, you're seeing a lot of pre-revenue companies or companies that have a vision that, they're still many years from realizing. How do you, as an angel investor, think about valuation at a very early stage?
Well, we start with the market, like comparables, what's happening in the market, obviously. Similar companies, similar stage. But then it's a lot of qualitative. We look, I think it's called step up. There's all sorts of different ways to call it, but the steps, so different qualitative factors of the company and add up all those qualitative factors. So size of market, if it's a big size market, that's good. Do the founders have previous exit experience? What's the IP strategy? How far along are they? And all the different milestones, and try to have these qualitative amounts and add them all up to get to some sort of valuation. So the more milestones, the more experience, the more you've established the company, the more, as an angel investor, we would value we would give it, because we don't, it's too hard when we're looking at these very, very early stage companies to be able to say, yeah, that revenue is reasonable. Like, we're just finding that is not a good place for us to start.
Yeah, and just to be clear, for those that don't know, there are a couple tools out there for pre-revenue companies. I think you referred to Step Up, but if you do a little bit of research online, you'll come across a couple different models that kind of walk you through valuation ideas and tools. Adrian, what about you guys? I mean, you guys are doing a fair bit of life science investing as well.
Yeah.
A fair bit of clean tech investing. Many of those ventures are years
away from revenue.
From
yeah.
revenue, yeah.
So yeah, one of the methods you're talking about is the Burkus method. I think he actually updated it recently. It's a good one. For life sciences, I don't think it works. Like it.
I agree.
If you want me just to talk about, I know we're in the Life Science Innovation Hub, so it's maybe mostly life sciences companies, and I think about 30% of our capital has actually gone towards life sciences companies. They've done very well in our summits. It's different, right? Your capital needs are so high, and your pre-revenue for so long. A lot of the industry average numbers we talk about don't apply. That we need to separate that and just look at life sciences companies on their own. But for me, when we look at it, it's truly it's the size of the market, how big. At the end of the day, the higher the risk, the higher the reward has to be. So how big is this opportunity truly? Like, how many patients, how many dollars is this going to generate? How many patients is it going to help? How quickly are you going to be in the U.S., which is they spend the most on healthcare? Let's be really honest here. Like, they spend the most. So if you're a life sciences company, you really want to be targeting the U.S. market. Unless you've got something that's going to be mass market, India, somewhere else. Like, you want to go where the biggest opportunity is. And the regulatory pathway, of course, is super important. And there are different capital requirements depending if you're developing a therapeutic, and you have to do thousands of people clinical trials. And Luke knows a lot more about this than I do. But then there are, whether you're doing a class 2 or class 1 device even, that's going to be a lot quicker to market. So that obviously is a consideration too. So at the end of the day, I have a hard time telling a founder in life sciences that their valuation's wrong. But unless I think that I know that the capital plan that they've laid out, which is well thought out, and that they've added a multiple to whatever they think then I might have a problem. But when I look at what they need for 18 to 24 months, so I know how much they need, and I say 25% of the company is that, then I think they're being reasonable. If all of a sudden it's 50%, or sorry, not 50, 15% or lower, then I start saying, well, maybe your valuation's a bit high, and here are the reasons why I think so. You're going to need we can map out all the places you're going to need capital. We can map out your ownership position, and we can back calculate, does that make sense to the market opportunity? Yeah. But we can figure that out. The other thing I will say as well, because I thought this is an important thing to say. We talk about valuation a lot, but valuation really is only once you have a price, right? A lot of the life sciences we're raising on convertible instruments, we're raising on safes, we're raising on caps. Those are not actually valuations, right? Valuations when you have an exit or a price, and so actually that it's an important distinction, I think, here. And when you're raising on a safe or something like that, the other thing is that cap price is not necessarily the valuation. Your valuation might be much higher when that thing converts, right? That's just what we're investing in. It's a bit of a risk valuation. And I know, Pete, you probably know a lot more about this than I do.
So so far we've had like more formulaic for companies that are, say, SaaS companies. There's tools out there. There's actually pre-revenue models that are out there. There are examples of how you could argue for valuation. I think, Adrian, you're saying like for companies that are a long ways from revenue, that have, I think it's an important, could be a topic on its own, but very large addressable markets, therapeutics, things like that. You can kind of do a reverse capital approach and say, does this round make sense relative to what it's going to take to get from A to B as potential? Luke, anything to add? Any other sort of like how to argue for your valuation recommendations?
Yeah, I think a lot of the good points were covered, but in general, the answer we like to hear is when we ask, run us through your valuation, is not because my advisor told me to. And I think that's the finer art of being a startup founder, is that we know that you did your research, you know your TAM, SAM, SOM, you did your competitive analysis, that's how we look at a TAM, and then we look at market saturation, competitors, right? And then you tied that together with your milestone, which will securitize the asset as much as possible, right, at the bare minimum. So if you're able to give us a very comprehensive study of the market, your competitors, your milestones, and very nitty-gritty calculation on how you got there, that I think is one of the more impressive things we see when we're talking about valuation. What we don't like is, I went on PitchBook or I ran my Bloomy and saw comparables, right? We're not doing DCFs here. This is pre-revenue companies. So, I think that and combining with your expertise, and I'm going to just focus on health. B2B digital health, SaaS, completely different ballgame than, let's say, therapeutics or even longer diagnostic, right? So if you can leverage your training and your background in that field to say, I know this for a fact, or I did my research and therefore I calculated this and built it in-house. It's an in-house built model. I think that's what makes it really compelling, because not only are you arguing for your valuation, it gives us trust that this founder has done their homework and knows this field really well, and also has baked in their milestone and the vision of the company that is fair for the valuation at its price.
Excellent. So just one piece that came up as part of the discussion was majority of the time we're not doing price rounds on these early stage investments. So just quickly, Luke, and then pass it down, like preferred tool for early stage investment. What's your preferred tool?
Yeah, I think, for us now, Y Combinator made safe like best thing since sliced bread, but I think convertible note is good because it adds a little bit of bells and whistles given the current market condition. Like, for example, what's prime right now in Canada? 6.7. So if you're able to throw in convertible at least at 6.7, right? It gives a little bit of bells and whistles for our investors to chew on. So I would say that's probably the most preferred and also popular ones we've seen, safe and convertible notes.
Adrian, what about you guys?
Depends on the stage of the company. So for a life science pre-revenue company, yeah, I mean, I personally, I'm at TNT. We like safes. We're happy with safes. With either founder friendly. As an investor, if I was truly, I think a convertible note is probably got more security for me. Certainly, in venture, interest rate of 6 to 9%, like doesn't really move the needle for me. Like I want to see this company get to a unicorn state. Like I want to see $1 billion company. So I'm not really into it for the 9% interest. So I like the safe personally, and we like the safe at TNT. But we do want to see terms. We do want to write in a information rights term. We want to see quarterly updates, and we do want to write in pro rata rights. So I didn't mention we have a VC fund that co-invests with our winners. We want to have pro rata rights because our fund wants to be able to follow on future rounds. And then the third term, because often we're early in a round, we're often the first check-in. We don't lead per se. Like we hope that you find a big venture capital lead. So we'll write in a most favored nations clause. Like we want, if a venture capital firm is going to come in and get prefs on convert, we want to get prefs. We don't want to be stuck there in voting in commons when everyone else is getting prefs. So we want a most favored nation clause.
Yeah.
Those
So safes, but with some
with
more
some things that make it
standard-
look a little bit more like a convertible note.
Yeah, absolutely. Meg, what about you?
We're good with safes or convertible notes. I do like the security of a convertible note, but I think we've done more safes, and we're fine with that. But we like the most favored nation. We like the pro rata rates as well, and the cap and the discount. We'd like to see that, but we've done convertible notes as well.
Excellent. Yasmine?
I feel like it's my duty to say I like equity, but in all honesty,
that's fair. Yeah.
As a pre-seed fund or in seed stage fund, we'll do any convertible instrument. But yes, it's all the bells and whistles. If you're doing a safe out there, there will be more clauses to be added. It's a lot about conversion terms, so that we're not stuck with an investment that goes nowhere and capital actually doesn't get turned into equity end of the day. But I also will say safes are a lot harder for us as a team to convince our investment committee of investing in. Pardon me. So keep that in mind as you're going out to institutional investments and venture firms. But convertible notes are great, and equity is fantastic if you're willing to put a price to it at this early stage. I know it's difficult, but really what I want to pick up on is the pref shares. That's a very big piece of the pie for us, especially when markets are turning downwards. It's something that we're seeing matter very much so in our valuation exercise. So if it's a safe with a preferred share to that next round, convertible note, same thing, right? We're doing our job right for that.
Do you feel, do you guys, when you look at, say, a convertible tool, whether that be a safe or a note, do you think about the cap as a valuation, or do you think about it differently? Maybe just yes, we think about a valuation, or it functions more as something to protect our investment.
Yeah, and very quickly, we do think that it's a benchmark for your valuation effectively. That's what we will consider it that way, so that it's realistic with what your goals are and what you might be at next round. But also just to answer that little bit of, can you go behind or lower than the cap? Markets will change at all times. So I don't think we'll look at a cap and go, we would never go below it. It's possible, and it's happened to our companies that are in millions of revenues because of the market conditions today. So I'll stop there, though.
Meg, how do you think about caps in terms of, do you think of them like a valuation, or do you think about them as something to protect your investment?
I think we initially thought about it as protecting our investment. It's where the valuation, for protecting the investment. I don't really have much more to add on that, though.
Yeah.
But we, it does feel to me when we're talking to founders that they, it does seem to me that they think it's more of a valuation of their company at that moment, and so there's a bit of a disconnect, I think, on that.
Yeah. Adrian?
Yeah, I tend to think of it more in terms of positioning for the next rounds. And frankly, to me, why I like safes and convertible notes for some reason to some extent as well, is because it sort of removes the valuation discussion today. It's saying that I do believe by the time you need money, by the next time you need money, you'll be worth at least this then, and probably, hopefully, more. And if you're not, I might get a discount to whatever you're then raising at. And I know that thinking of it as a minimum is probably dangerous. 4 million is low, but we'd see a lot of Series B. I think we see a lot of Series B and Series C rounds at lower valuations than the round before that. Like, there are a lot of down rounds, and there's absolutely no reason why that can't happen at a seed round when below a pre-seed. There's no reason at all. If market conditions to the point, it will dominate that. But it is good when you're looking at a company and you're thinking about investing. Frankly, you're optimistic and you're hopeful, and so you're thinking, okay, is it real? Then you're just checking realistic. Is it realistic that this company could be at least this and hopefully double in 2 to 3 years' time when they need money again? So that's kind of how I think of it. I'm very much looking forward and not really at today.
Luke?
What's a safe? Safe short for simple agreement for your future equity, right? So it's all speculative if we really want to boil it down comparatively straight price round, right? People don't like uncertainty. They're not comfortable with it. So how do we see a cap? Well, it's not a valuation, but I think everyone on the panel has eloquently put how we see it. So, lower cap means that there's less risk of a down round, which means that there's more possibility of surpassing that if you guys do your job, which means that the discount will be more effective for us if there's a discount on the save. So, yeah, I think a cap is more assuring than not if you're going to use the safe vehicle to tack on there. Whether or not there should be a minimum, I don't know. I think that's really at the founder's discretion. It's like, what can you beat? What are you made of? What is the company that you're selling here, right? So, like everything, yes and no. A lot of variables to look at. You need to look at so many things to get the whole picture. That's why we have a lot of smart people here doing a lot of analysis. I think that's the last panelist answer I can do, given that all the answers are gone.
It's a problem with being at the end of the row, Luke. You passed it, remember, you passed it down, right? I want to be respectful of the panel's time. Really appreciate you guys coming. Any last questions that anyone want to try and get out there before we close things off here? Again, Y Combinator, I think, has set a good example and a bad example.
These days, 20% discount's pretty typical. We don't, out of the over 260 deals that we see in life sciences and health, I don't think we saw any much deviance in terms of other than 20% discount on a safe for a seed, pre-seed.
Yeah. Yeah. I mean, we want cap, and we want we don't have demands. We don't lead, right? But if we're going to write that first check, it's generally a 20% discount safe. Generally, certainly happy to have conversations around different interest, different discount levels, but generally it's 20% because again we're hoping that you're going to be hoping it's also an incentive to be much higher than the cap, right? But if it's uncapped, then we have a real tough time with uncapped safes. I think in general.
Yeah, I'd agree with that. We've seen 25% discount recently as well with the pressure and on pricing. But it's the cap and definitely a valuation cap. I'd agree with that. An uncapped safe is just not interesting to us at this time. But 20 to 25%. Somebody showed us a 30%, but it wasn't a company we ended up investing in. But they were definitely trying to appeal to more people, more investors.
Yeah, market is what we're looking for. So 20% is pretty typical. I will say we've seen 50%. We didn't do that deal, but it was because the deal structure was really, really rough. But it depends on the deal itself. But market rates are typical.
Yeah. And I think Adrian made the comment. That's one thing that definitely has changed in the last couple of years. We were seeing uncapped safes in the last couple of years, particularly in 2021. I would say, like everyone I talk to now, all our boards, investment advisor boards, are saying absolutely not to uncapped safes. So I think that's definitely one thing that has changed quite quickly. So anyways, on behalf of the group here, thank you guys so much for your time and for sharing your experience. And yeah, let's give them a big hand.